On Tuesday morning, Mexico's peso was stable. By Thursday, it was wrecked. Not over years, not over months, over 48 hours. In 2 days, the peso lost half its value. The stock market collapsed. $50 billion fled the country. 1 million people lost their jobs. The middle class was destroyed. And when Mexico begged for help, Washington did not debate saving Mexico. It debated saving Wall Street. January 1995. Treasury Secretary Robert Rubin walks into the Oval Office. He tells President Clinton that Mexico needs money. $25 billion? A political advisor says, "You mean 25 million?" Rubin says, "No, 25 billion. With a B, the biggest bailout in history." Mexico lit the fuse. But Washington wrote the rules, sold the dream, and designed the rescue. To understand those 48 hours, you have to understand the trap that America helped build. December 19th, 1994, Mexico City. President Ernesto Zedillo has been in office for 3 weeks. He inherited an economy standing on the edge of a cliff. His predecessor left him a time bomb with the fuse already burning. The peso was pegged to the dollar, fixed, unchanging. This was supposed to create stability, attract foreign investment, show the world Mexico was open for business and ready to join the first world. Instead, it created a trap. Foreign money had flooded in, $50 billion between 1990 and 1994. American pension funds, hedge funds, banks looking for higher returns than they could get at home. Mexico was the hot new market. But it was hot money. Portfolio investments, stock purchases, short-term bets that could leave as fast as they came. This was not money-building factories or creating jobs. This was money chasing quick profits. To keep the peg, Mexico had to burn through its dollar reserves every time investors got nervous. Every time someone sold pesos, the central bank had to buy them with dollars to maintain the fixed rate. By December, the reserves were almost gone. The cupboard was nearly empty. Zedillo's advisors showed him the numbers. They were brutal. The peso could not hold. The math did not work. Something had to give. The only questions were when and how badly it would hurt. On December 19th, Zedillo made his decision. He announced a 15% devaluation. Not a float, not a gradual adjustment, a sudden cut, overnight. The peso would be worth 15% less tomorrow than it was today. The announcement was a disaster. It was handled badly. Zedillo had been in office 3 weeks. His finance minister had no plan to calm markets. No explanation of what would happen next. No roadmap for recovery. Just an announcement that the peso was worth less than yesterday. Investors panicked. If Mexico was devaluing 15% today, how much would they devalue tomorrow? 20%? 50%? Nobody knew. The government was not saying. So everybody ran for the exits at the same time. Within 48 hours, the peso went into free fall. The government gave up trying to defend it and let it float. The peso lost half its value in 2 weeks. Half. A lifetime of savings cut in half. Interest rates shot to 80% as the central bank tried desperately to stop the bleeding. The stock market crashed. Banks started failing. Credit froze. 1 million jobs vanished in months. Mexico was broke. The economy was in ruins. But to understand why Mexico was standing on that cliff in the first place, you have to go back 1 year to the promise that put them there. January 1st, 1994. NAFTA goes into effect. America had promised Mexico that free trade would bring prosperity. Factories would open. Wages would rise. The gap between American and Mexican living standards would close. Mexico would join the first world. The peg also made the peso overvalued. Mexican exports became too expensive for foreign buyers. Imports became too cheap for Mexicans to resist. Mexico was buying more than it was selling. The trade deficit grew and grew. By late 1994, reserves were draining fast. Every time investors sold pesos, the central bank had to buy them with dollars to maintain the fixed rate. The government spent billions defending a currency it could not save forever. And politics made everything worse. March 1994, presidential candidate Luis Donaldo Colosio is assassinated at a campaign rally in Tijuana, shot in the head at close range. The man who was supposed to be Mexico's next president, dead in an instant. The murder is never solved. Conspiracy theories multiply. Was it the drug cartels? Political rivals? The old guard of the ruling party? Nobody knows. The uncertainty itself becomes destabilizing. September, another senior politician murdered. Jose Francisco Ruiz Massieu, the ruling party's Secretary General, shot outside a Mexico City hotel. Another investigation that goes nowhere. Mexico is unraveling. The political system that had held the country together for 65 years is showing cracks. The Zapatista rebellion continues in the south. Assassinations at the top. Investors start asking, is Mexico stable? Foreign money starts pulling out. Not a flood yet, but a trickle. The peso is under pressure. The reserves drain a little faster, but the government refuses to devalue. President Salinas wants to leave office with the peso strong. His legacy depends on it. So they spend the reserves defending a fiction. They maintain the peg even as the foundation crumbles. The American government knows Mexico is in trouble. The U.S. Treasury sees the numbers. The reserves are running low. But Washington says nothing publicly. They do not want to cause a panic, so they keep quiet and hope for the best. In August, Ernesto Zedillo wins the presidential election. He inherits the cliff, an overvalued currency, empty reserves, hot money ready to flee, political instability. 3 weeks after taking office, he announces the devaluation. The panic begins. The 48 hours that destroyed Mexico's economy. And now came the bailout. Mexico cannot pay its debts. The government has bonds coming due that it cannot cover. Default is days away, maybe hours. If Mexico defaults, it will not just be Mexico's problem. American banks have lent billions to Mexico. American pension funds bought Mexican bonds. American hedge funds made big bets on Mexican stocks. A Mexican default could trigger a chain reaction. Treasury Secretary Robert Rubin and his deputy Larry Summers walk into the Oval Office. They tell Clinton the situation is dire. Mexico needs money. A lot of money. $25 billion to start? One of Clinton's political advisors blinks. You mean 25 million? Rubin says no, 25 billion. With a B, the room goes quiet. Another advisor warns Clinton directly, if you send that money to Mexico and it doesn't come back before 1996, you won't be coming back after 1996. The midterm elections had been a disaster for Democrats. Clinton's re-election was not certain. The American public does not want to bail out a foreign country. They are tired of sending money abroad. They have problems at home. Why should American taxpayers rescue Mexican banks? Clinton decides to do it anyway. But here's what he did not tell the American people. The bailout was not really for Mexico. It was for Wall Street. Wall Street firms were heavily exposed to Mexico. They had sold Mexican bonds to pension funds, mutual funds, and wealthy investors. They had their own money in Mexican stocks. If Mexico defaulted, the losses would be staggering. Goldman Sachs had been one of the main firms marketing Mexican bonds to American investors. They had made big commissions, selling Mexico as a hot investment. Their former co-chairman was now Treasury Secretary Robert Rubin. The man deciding whether to bail out Mexico had spent his career at the firm most exposed to Mexico. Think about that for a moment. The fox guarding the henhouse, the man who sold the bonds deciding whether to rescue the bondholders. The bailout would allow Mexico to pay back its foreign creditors. Who were the foreign creditors? American banks, American investment firms, American hedge funds. The money would flow through Mexico and land right back on Wall Street. Clinton asked Congress for $40 billion in loan guarantees. He made the case that Mexico was too important to fail, too connected to American business, too close to the border. President Carlos Salinas had bet everything on this deal. He was Harvard educated. He believed in free markets. He believed that opening Mexico to American trade and investment was the path to development. He told his people, trust America. The same day NAFTA begins, something else happens. In the southern state of Chiapas, indigenous farmers rise up in armed rebellion. They call themselves the Zapatistas. Their leader wears a ski mask and smokes a pipe. The Zapatistas say NAFTA is a death sentence for the Mexican peasant. Cheap American corn will flood in and destroy Mexican farmers. Free trade means freedom for corporations and poverty for workers. They choose the first day of NAFTA to make their point. The government calls them terrorists. Washington calls them a local problem. The global media romanticizes them as noble savages fighting modernity. But they were right about one thing. American corn was subsidized. The U.S. government paid American farmers billions of dollars every year to grow corn. Subsidies that made American corn artificially cheap. This had nothing to do with efficiency. It was taxpayer money disguising the true cost of production. When NAFTA dropped the tariffs, this subsidized corn flooded into Mexico. Mexican farmers growing corn on small plots with family labor could not compete. They were not inefficient. They were not lazy. They were fighting against the U.S. Treasury. The Mexican government had promised to help farmers transition. Funding for new equipment, training for new crops, support during the adjustment. The funding never came, or it went to large agribusinesses with political connections instead of small farmers who needed it. Within a decade, 2 million Mexican farmers lost their land. 2 million families. Entire villages emptied out. A way of life that had existed for centuries, destroyed in years. Where do they go? North, to the border, to the maquiladoras, or across the border to America, looking for the jobs that NAFTA was supposed to create in Mexico. NAFTA did not stop illegal immigration. NAFTA caused it. NAFTA did bring factories. They were called maquiladoras, assembly plants along the U.S.-Mexico border where American companies could use cheap Mexican labor to assemble products, then ship them back to America, tariff-free. Before NAFTA, maquiladoras employed about 400,000 workers. After NAFTA, that number tripled. By 2000, over 1 million Mexicans worked in them. Sounds like success, but look at the wages. $55 a week, 45 hours of work, about $1 an hour. In border cities where the cost of living was higher than rural Mexico because of all the migrants flooding in. In 1994, Mexican manufacturing wages were 23% of American wages. By 2002, after 8 years of NAFTA, they had fallen to 12%. The gap got worse, not better. NAFTA was supposed to raise Mexican wages toward American levels. Mexican wages fell. The factories were islands, parts shipped in from America or Asia, assembled by Mexican workers, shipped out to American consumers. The profits went to corporate headquarters in New York or Detroit. The technology stayed in America. The pollution stayed in Mexico. The border cities became nightmares, overcrowded with rural migrants, housing shortages, overwhelmed hospitals, crime exploding. Women working night shifts started disappearing. Ciudad Juarez became one of the most dangerous cities in the world. While farmers lost their land and factory workers earned poverty wages, something else was happening that would bring it all crashing down. Hot money was pouring into Mexico, not into factories or roads or schools, into the stock market. NAFTA made Mexico fashionable on Wall Street, a country opening up, dropping tariffs, privatizing industries, the next big emerging market. American investors wanted in. $50 billion flowed in between 1990 and 1994. But most of it was not patient capital building businesses. It was hot money that could leave at the first sign of trouble. The peso peg was supposed to reassure investors. Your dollars will always convert to the same number of pesos. No currency risk. Safe and stable. But to maintain the peg, Mexico had to keep interest rates high. High rates attracted foreign money, which supported the peso, but high rates also strangled Mexican businesses that needed to borrow to invest and grow. Congress refused. Republicans and Democrats both balked at bailing out a foreign country. Their constituents were angry. Why should American taxpayers rescue Wall Street's bad bets on Mexico? So Clinton went around Congress. He used something called the Exchange Stabilization Fund. This was a treasury account created in the 1930s to protect the dollar. Clinton used it to protect Wall Street's Mexican investments instead. No congressional vote needed. $20 billion from the U.S. Treasury, another $17 billion from the IMF, where America has the most influence. $10 billion more from other sources. $50 billion total. The largest financial rescue in history up to that point. And it came with strings attached, strings that would strangle Mexico's recovery. The IMF and Treasury did not just give Mexico money, they gave Mexico orders. Follow these rules or the money stops. Cut government spending, raise interest rates even higher, privatize state-owned companies, open your economy even more to foreign investment, slash subsidies for food and fuel, reduce the budget deficit. They called this structural adjustment. The theory was that Mexico had been living beyond its means, spending too much, borrowing too much. The solution was fiscal discipline, tight budgets, balanced books, pain today for prosperity tomorrow. Critics called it economic strangulation, the same medicine given to every patient, regardless of the disease. Cut and privatize, squeeze and sell. Mexico raised interest rates to 80%. Let that number sink in. 80%. Imagine trying to buy a house when the mortgage costs 80% a year. Imagine trying to start a business. Imagine trying to keep a business alive. Nobody could borrow at those rates. Businesses that needed credit to survive could not get it. Construction projects stopped mid-building. Expansion plans were shelved. The economy froze. The cure was worse than the disease. Mexico had to cut government spending while the economy was collapsing. Schools lost teachers. Hospitals lost doctors. Roads did not get repaired. Social programs were slashed. The people who needed help most during the crisis got the least. Mexico had to privatize its banks. After the crisis, the banks were nearly worthless. So American and European banks bought them for pennies on the dollar. Fire sale prices. Within a few years, over 80% of Mexico's banking system was owned by foreigners. Mexican money, controlled by New York and London. And what did these foreign-owned banks do for Mexico? They raised fees. They cut lending to small businesses. They focused on wealthy customers who could afford premium services. They sent profits back to their home countries. Credit for ordinary Mexicans dried up completely. The bailout saved Wall Street from its bad bets. The conditions crushed Mexican workers and businesses. The numbers tell the story, but behind every number was a family, a life, a dream that died. Mexico's economy shrank by 6% in 1995. That is not a recession. That is a depression. The worst economic contraction Mexico had experienced in decades. An entire year of economic output gone. 1 million Mexicans lost their jobs in the first year of the crisis. Factory workers, construction workers, bank employees, shop owners, professionals. Anyone whose employer could not survive 80% interest rates. Real wages fell by 20%. For workers lucky enough to keep their jobs, their paychecks bought 20% less. Less food, less medicine, less education for their children, less of everything. The poverty rate rose from 45% to over 50%. More than half of Mexico is now officially poor. The middle class that NAFTA was supposed to expand? Destroyed. Mexicans who had saved money saw their savings cut in half overnight. The peso they held was worth half what it had been. A lifetime of careful saving, gone in 48 hours. Mexicans who had borrowed in dollars saw their debts double. The dollars they owed suddenly cost twice as many pesos to repay. Mortgages became unpayable. Cars were repossessed. Businesses that had taken dollar loans went bankrupt, even if they were otherwise healthy. In Washington's response to all this suffering, the Clinton administration declared the bailout a success. Mexico paid back its loans 3 years early. America made $600 million profit on the deal. A good return on investment. Success for whom? Mexico paid back the loans because it squeezed its people. The austerity, the high interest rates, the privatizations that sold national assets to foreigners. Mexican workers paid for Wall Street's rescue with their jobs, their savings, their futures, their children's futures. The crisis did not end in 1995. Its effects lasted decades. Some argue they never ended at all. Mexican wages never recovered. In 1994, Mexican manufacturing wages were 23% of American wages. NAFTA promised that gap would close. Mexican workers would catch up. By 2014, 20 years later, Mexican wages were still around 20% of American wages. The convergence never happened. The promise was broken. The poverty rate in 2014 was the same as 1994. Think about that. 20 years of free trade, 20 years of NAFTA. Poverty did not budge, not 1 percentage point. Mexico's economy grew at just 1.3% per year between 1994 and 2013, slower than the rest of Latin America, slower than countries without fancy free trade agreements, slower than Mexico had grown before NAFTA. 2 million farmers lost their land to subsidized American corn. They became migrants. They became maquiladora workers. They became undocumented immigrants. In 1995, about 2.5 million undocumented Mexican immigrants lived in the United States. By 2007, that number had grown to over 12 million. NAFTA was supposed to keep Mexicans in Mexico by creating jobs at home. It did the opposite. This is the pattern. America promises prosperity through free trade, capital floods and chasing quick profits. Then crisis hits, money flees. America offers a bailout with conditions that crush workers and sell assets to foreigners. It happened in Mexico. It happened in Asia in 1997. The pattern does not change, only the target. NAFTA was not designed to help Mexico. It was designed to help American corporations access cheap labor in Mexican markets. The 1994 crisis was predictable. Hot money plus currency peg plus political shocks equals collapse. Economists warned it would happen. When crisis hit, Washington's priority was protecting American investments, not helping Mexico recover. The $50 billion did not go to Mexican workers. It went to creditors, through Mexico, to Wall Street. When you hear politicians talk about free trade, remember Mexico. Remember the promise: prosperity, jobs, rising wages, a shrinking gap between rich and poor nations. Remember the reality: poverty wages and maquiladoras, 2 million farmers driven off their land, mass migration, a middle class destroyed in 48 hours. When you hear about financial bailouts, remember Mexico. Remember who got saved and who paid the price. Wall Street made bad bets on Mexico. Wall Street got rescued. Mexican workers lost their jobs, their savings, their homes. Mexican workers paid for Wall Street's mistakes. When you hear about illegal immigration from Mexico, remember what caused it. 2 million farmers driven off their land by subsidized American corn. An economy that never delivered the promised jobs. A crisis that crushed the middle class. A bailout that helped Wall Street and strangled Mexico. People do not leave their homes, their families, their countries because they want to. They leave because they have to. Because staying means poverty. Because the system left them no choice. The 1994 peso crisis is 30 years old now. Most Americans have never heard of it. Most have forgotten, but its effects never went away. Mexico is still poor. The border is still chaos. The maquiladoras still pay poverty wages. The promises are still broken. And the same people who broke them are still making new ones. And America still calls it free trade. Now, you know what it really is.